How much life insurance do you need? Is it 10 times your income? More than that? Less than that? This is very commonly a source of confusion for a lot of people as they try to sort through the exact amount of life insurance they need. And there's a lot of confusing information on the internet. So today, let's get back to basics, talk about the simplest thing we can when it comes to life insurance, the death benefit and how much you need, and tell you exactly what approach I think is best to figuring out the number. There are two basic approaches, but we're going to add a third that I think you're going to like. So in general, there are two basic approaches to figuring out how much life insurance you need. We have the capital needs analysis, and then we have the human life value calculation. And of the two, the one that is by far the most popular is the capital needs analysis approach, which is a multi-step process of figuring out what sort of expense needs you have that your family would need to cover if you were to die and no longer be providing them with income. So we break down the various needs, income needs or expenditure needs that the family will have to figure out the exact amount of life insurance. And the process breaks down pretty simply as income replacement being one of the steps. And the most common income replacement number thrown out is 10 times your current income. In fact, in a lot of online media sources, individuals who talk mostly about finance and sometimes about insurance, the 10 times income recommendation that you'll almost always find when it comes to life insurance discussions generally comes from this part of capital needs analysis. In truth, capital needs analysis isn't all that deep in its approach to figuring out income replacement for somebody looking for life insurance and how much death benefit they need. Instead, it defaults to this 10 times number being roughly the necessary amount to give your family the lump sum of money it will need to replace the income that they're more or less going to lose when you die. But that's only one of the steps when it comes to capital needs analysis. And this is an area where a number of those blog posts or journals get it wrong because they forget the other pieces. It's not just 10 times your income being the typical recommendation. There's more to the process than just that. Next up in the capital needs analysis process, we generally want to calculate a transitionary period capital sum. So what I mean by that is the idea here is your family is going to make an adjustment if you die, and they're not necessarily going to live as they were living if you are no longer around, but we need to buy them some time to make that change in their lives. So the idea is if we take maybe 6 to 12 months of your earnings and set that aside as a separate amount, that will most likely buy them enough time to make the necessary adjustments to their lives and their lifestyle to move into this next phase of life without you. So the idea is there's a period of time, again, 6 to 12 months, that they won't really make any changes, but they'll be thinking about what expenses may not be necessary or what parts of their life they're going to make modifications to in order to deal with the reality that they no longer have the income that you used to provide them. And then lastly, we generally calculate a sum for big ticket expenses. The most common example here is college, funeral being another one. Anything that you're kind of saving towards and you want to make sure your family has the money immediately for if you are no longer around to take your income and continue to save toward that goal. Now, the last refinement to this, or the next step is a refinement to this money, which is to say that if you have savings, you don't necessarily need to buy all of these summed up capital needs as death benefit. So if you find out that 10 times your income plus the transition capital amount and college, for example, comes out to a number of, let's say, $5 million, but you also happen to have $250,000 in savings, well, you would take that $250,000 from the $5 million to figure out what the actual amount of death benefit is that you should be buying. Alternatively, to the capital needs analysis process or approach is the human life value calculation. Now, human life value is much less precise and specific to needs as they are expressed as expenditures that your family would face. And instead, it's much more focused on the theoretical value that you represent as an income earning individual. So the advocacy under human life value is your wage earning efforts have a value to them, a lifetime value to them. And we can figure out today in today's dollars what that is. And so that is the amount of life insurance you could, and many agents who advocate for human life value would strongly encourage you to buy that amount or as much of it as you can afford. And most life insurers are on board with this approach to the degree that this is generally the maximum amount of life insurance that you can buy. And beyond that amount, life insurers would be unwilling to issue you any additional life insurance policies. Now, I said earlier that agents who practice human life value would traditionally advocate you buy as much of your human life value as you can. And in general, the calculation from human life value will be a much larger number in terms of the death benefit you should buy relative to the capital needs analysis. And that happens because human life value is very much concerned with you trying to recoup all of your future earnings versus just caring about the potential expenses your family might face without you. In practice, it's pretty common for somebody to have an agent calculate their human life value and decide that's way more death benefit than I can afford. As an example, you may find out that your human life value is $12 million, but you could never afford anything more realistically than maybe $7 million of death benefit. What happens in that case most of the time for agents who are proponents of human life value is buy the $7 million and then work on a plan to buy up the other $5 million that you're not going to have because you don't have the budget right now to afford any more death benefit. The precise calculation for human life value is somewhat complex, but there's been a number of ways that it's been simplified over the years to basically just become a multiple of your income based on your age. And not surprisingly, this multiple is much larger when you're younger and quite a bit smaller when you're older. The idea is that you don't have as many working years as you age. So when you're young, the multiple might look something like 30 times your current income. But when you're much closer to retirement, let's say in your 60s, this multiple might look something like 5 times your current income. And again, to reiterate, human life value is not at all concerned about actual expenses you think you're going to face, because in theory, those will all be covered if we can recapture all of the lost earnings that would not happen if you were no longer living and no longer able to earn a living. So while capital needs analysis and human life value have largely been the two dominant ways insurance agents calculate death benefit need, and again, capital needs analysis is by far the more common and traditionally more favored, especially among financial planners approach, there is another way to do this. And I think it, as my own bias, is the way to approach death benefit needs. And what you're most likely going to discover is that it tells you your death benefit need is significantly less than human life value, probably closer to capital needs analysis, but has a slightly different philosophical approach to replacing lost income than capital needs analysis has. And I'll call this simply the income generation approach. So what we're seeking to do here is give you, or rather your spouse and children, the money that would be necessary to replace your earned income through various income-focused investments. Now, it's also possible that this approach would give you a death benefit need lower than capital needs analysis, though that's not usually all that common in my experience. The approach is pretty simple. We take your current income and we divide that by whatever yield we're going to target in income-focused investments to then create the capital sum that's necessary to give your family the resources they need to go out and recreate your income if you're no longer alive. There are a number of assumptions that we're going to have to make with this approach about yield and what we can realistically get. But I would tell you that the range for most people on average is probably going to fall somewhere between 5 and 7%. So to give you an example with real numbers of how this might work, if you've got $150,000 of annual income and we assume a 6% yield, you're going to need $2.5 million of life insurance to make that happen, to make $150,000 of income a reality for your family if you're no longer around. But here's where things can get interesting as far as the planning goes and why the amount of death benefit that you need could be significantly less, and it could be much less than capital needs analysis. Let's say we do find out you need $2.5 million of death benefit, but you also happen to have a brokerage account that's got $1 million in it. Well, I would argue you don't need $2.5 million. You need $1.5 million that'll then be added to that $1 million you've saved in investments, and your family will use that to recreate the income that you once had. The one thing that I do want to call out as a differentiator here, so capital needs analysis does tell you that you should deduct savings from your death benefit need. But in general, practitioners of capital needs analysis will include assets like 401k and IRA. I am not necessarily comfortable with that sort of recommendation because there are a lot of restrictions to the access of that money when it comes to the age of your spouse. So yes, you will leave that money to your spouse or theoretically your children if that's how you choose to do it. But their ability to use that money is limited based on their age. And if they're not old enough to access that money, then it doesn't necessarily do them any good to include that in the calculation of how we'll go about replacing your income with income-focused investments if you're no longer alive. Do want to drive the point here, though, that we are not planning to take any of the original principal death benefit amount or the investment account amount, if that's part of the equation here, and spending it. Capital needs analysis does plan to spend that money. Human life value does plan to spend that money. This approach with income generation says no, that money stays put and it becomes the mechanism that we use to create the income that's necessary to carry on life without you. I find this to be a much safer way of creating income without the worry of not having enough and running out of the money that was created from the life insurance policy. Now, there are some additional refinements to this process that you may discover are necessary as you start to dive into the details of how much death benefit you should buy for the sake of creating this investment income for your family. One, people generally worry about buying power being eroded by inflation, and that's a totally understandable concern. So we may bring the yield expectations down slightly in order to give us more investment income that we can use to reinvest for the sake of building up additional income. That doesn't mean that your family would use this income immediately if you were no longer alive, but would instead use it for the sake of increasing the amount of money that is saved by purchasing additional shares of investments that are creating income for them. Or if they're choosing something that's much more fixed interest approach, it would simply try to take that interest, add it to the principal balance, and further compound it for the sake of growing the income number higher in future years. So we have excess income we don't spend, we just reinvest it, and that gives us even more income over time to try and keep pace with inflation and what that ultimately does to buying power. The other thing we have to think about is the taxable consequences of the money that will be generated as income moving forward. So investment income doesn't have a FICA tax liability associated with it because it's not earned income. That increases the buying power of the income generated by the investments. But if you are no longer alive, your spouse will likely change filing status, which could very likely increase his or her effective tax rate a few years after you are gone. Also, if we're choosing to use investment accounts that are tied to the stock market or bond market, for example, those yields can fluctuate over time, and that might result in having to change approach or strategy when it comes to creating investment income that's necessary to replace what you once were earning while you were living. The easiest way to hedge that consideration is, again, to be a little conservative in terms of our yield expectations from the outset. So if we realistically think we can get 6%, we might do the calculation based off 5 to give us a little more margin in the pursuit of hedging against the possibility that yields change. Now, there's also a bonus to this approach that has absolutely nothing to do with insurance planning and everything to do with retirement planning. It gives you a really good sense of what you need to save to retire, because now you know how much money you're going to need to have to create the income that you currently earn through investments. If we do this calculation for $50,000, assuming 6% yield, gives us $2.5 million necessary to recreate that $150,000 of income. Well, if you happen to save up to $2.5 million, you'll know that at a 6% yield, you can create $150,000 of annual income, and you might decide at that point you're going to retire. That allows you to sort of gauge where you're at right now savings-wise with where you're trying to get to in respect to income generated passively through investments versus wage earning activity. Ultimately, the approach that you choose to take to figure out how much death benefit you need is going to be unique to your circumstances. While I personally favor the income replacement approach over capital needs analysis and human life value, it doesn't mean that people who choose one of those other two approaches is necessarily wrong. But I think you can tell from the information that we've discussed already that having a little more plan than just this article told me 10 times income, so that's probably good enough, or I have some multiple of my salary through work, so that's pretty good. That's not exactly the best approach that you should take.